He's angry about mortgages. It's Angry Mortgage. He's swearing. He's cursing loud. He's old. He's opinionated. And he's been doing this so damn long. This program is about mortgages, and this is mortgage advice, but the advice may not apply to your situation. Contact licensed mortgage professionals for specific recommendations before you make decisions about mortgages. You may not agree with Ron, but if you don't, he thinks you're wrong. Oh, and did we say there is a lot of swearing?
And we are back. It's Angry Mortgage. We are really, it's exciting. A guest we have today is really exciting. Julian Schoenfeld, I'll do it all the way. I'll do Chief Investment Officer of CAPREIT. Now, CAPREIT's just the biggest multifamily REIT in Canada, right? It's that simple. Okay, you're the biggest landlord in Canada.
Yep. We've got about $15 billion of assets. We're in the TSX 60 and the largest float of all the other REITs. Yeah.
So this is the great thing is you are across Canada. So you're from the Maritimes.
Yep.
How to describe it? Like what's sort of
We're in all the major markets. So
every major market.
All the way from Victoria, Vancouver to Halifax, Charlottetown,
Quebec?
From coast to coast. Yep. Montreal and Quebec City. Yeah.
All right. So let's do a dive on how your business works. So first of all, just tell us the basics. Tell us you're this huge operation. So tell us how a little bit of how it started and how it's facing the future.
Yeah, so we're a public company. We're listed on the TSX. We're the only REIT in the TSX 60. We IPO'd in 1997. The history of the REIT was really one of kind of aggregating scale. So the company was buying assets, raising equity, and rinse and repeat. Mm-hmm. It got a little bit spread out or diversified. So there were some ancillary businesses that were bought. There was MHC Communities. It was the second largest portfolio in the country.
That's like trailer homes.
Yeah. That's exactly it. And there was an investment in Ireland, an investment in Netherlands as well. Yes. And a lot of apartments bought throughout the mix. And so right now, and you know what, that worked brilliantly while we were getting to a spot of scale. Scale is really important for a public company. We have that. And while interest rates were going down, the more you bought, the better off things went. So it worked brilliantly. We're in a different environment right now. And so right now we're looking inwards and we're trying to make what we have more focused and better. And so we sold the MHC business last year. We sold the Irish investment and we've sold half of the Netherlands investment. Mm-hmm. We've also sold a lot of what we would say are the kind of non-core apartments that are in the portfolio, and we continue to do that.
So define that a bit, the non-core.
So the non-core would be ones where there's overly punitive regulatory environments where we perceive there to be...
Okay, so that's different provinces too, obviously. Some provinces or even municipalities can be bad, right?
Absolutely, right? And, a good example of that was what we went through in Prince Edward Island, where they've got full rent control, and, there's been a couple of years where they've pegged it really, really low, including 0%.
0%?
0% on renewals and turnover. And I can tell
you. On turnover? Wow.
On everything, right?
Wow.
And they put an out-of-province extra property tax. And so...
Hold on, I got to stop you for a second, because I sort of understand if people are buying homes, sort of taking homes away from island residents in theory. But you were there already, right?
Yeah.
So what sense does that make?
Yeah.
Okay.
No, I know. And so it didn't make sense to us. So stuff like that, where there's overly burdensome CapEx exposure there, where we just don't think we can be as operationally efficient if it's something located very far that came in a portfolio and it doesn't make sense for us to own. There's a whole host of criteria. Are we overweight in a city relative to the whole portfolio or underweight? And all of that gets factored in there.
Gotcha. So is it fair to say that sort of golden 13 years from 2008 onwards for a time of extremely low interest rates in Canada was a great benefit to that kind of acquisition formula?
Yeah, absolutely. It really helped, and it rewarded more aggressive expansion, which is what CAPREIT did. And so it treated us and the investors very well. Again, we're now in a different environment and less so in aggregating and more so in enhancing the portfolio quality. And that's what we've been doing. And so even if that means retracting or shrinking a little bit in the interim, that's completely fine as long as we're making the offering for our owners better.
Right.
And we've done good progress on that.
So the market is kind of, because you are part of a sort of a small universe of REITs. Okay, is it fair to say the market sort of punished you lately because you're in that whole space?
Yeah, the REIT sector's been hit pretty hard. In September, when rates started coming down, the REITs were trading well. We were trading above our NAV, which is effectively the fair value of our assets. So we were trading above there, and that's when things function normally. You can raise equity, you can buy, you can do everything. After that, when they announced the population growth changes, the multi-res REITs, well, all the REIT space, but the multi-res REITs, they were punished pretty heavily. And then, you throw on top of that all the federal election uncertainties and some of the tariff stuff, and all of that uncertainty caused us to trade at pretty wide discounts. Like right now, you can buy the stock at 25% below what it's appraised at, or what the fair value is, right? And so it's incredible. You can buy it at a low 5 cap rate. It doesn't really make sense. It's more the macro sentiments, but you can buy something that's got really robust growth, a high enough cap rate at the current pricing, and a really cheap cost of debt financing.
But you're sort of stuck in a universe of situations where you're the multifamily REIT, but a lot of the other REITs are diversified. And if you're somebody like RioCan and the news comes out about Hudson Bay pulling the plug, that's not a good look, right? I mean, that's a problem for, and there is obviously, in the case of the chance of population decline, my thesis is there's real population decline, and we will see. By the way, there's fighting on that. There's fighting on this. We got, and some people have vested interest in maintaining the idea that population will still be robust. There'll be strong growth, but I'm in the camp of thinking maybe not.
Right.
Because the reality is that there are going to be 350,000 to 400,000 new permanent residents in this country in 2025, but they're already here. Like, we're not bringing any of them in. They're temporary workers, they're students, whatever they are, but they are the group that we will draw it from are here. They're not coming from another country.
Yeah, NPR is becoming PRs.
That's correct. So yeah, that is to my mind, that is a challenge. But as you say, and we're going to get into it a little bit more, it's more, I would worry about it more if I owned a lot of retail space, right? If I was a landlord in retail, I'd worry about that kind of difficulty more than if I would worry about multifamily. And certainly, even logistics, I think, could take a little tamp down, right? I mean, if you're heavily invested in warehouses and distribution centers, they may not grow. There may not be any growth there.
Yeah, I mean, the reality is we've had population growth that has been so disproportionately higher than housing supply. You look at housing starts, and they've been in the 200s, in the low 200,000 range. Yeah. Whereas you've had population growth that's hit, north of 1 million for a few years in a row. It's created pent-up demand, right? Like the amount of people that came in versus the housing supply, of course, there was a ton of roommating that's been happening, not just in that new supply, but throughout, right? And that's why you see the vacancy rates being so low and so tight. So yes, there might be a little bit of pressure on that front, but we think with all the roommating that's going on, that can help supplement some of the lower population growth in there.
Yeah, of course, negative population growth isn't going to be a good thing.
No, I mean, you know what? I'm going to cut you off, but the other thing that's worth mentioning, the housing supply, we say it stayed flat because it's been in the low 200,000 range, but if you look at it, you go back 20 years ago, it was predominantly singles, semis, and rows.
Absolutely, right? Was, yes.
You look at the chart now, and you have to wear your reading glasses to see the portion of it that's actually singles, semis, and rows now. Yeah. It's vastly condos, and a lot of them in the major markets are quite small. So if you translate that from not units, but into either bedrooms or into square footage, you'll see actually the housing starts have gone down by more than 25%.
Yeah, we're going to talk about that in a minute, but you're quite right. Since 2018 in Canada, but particularly in Ontario, and let's face it, I mean, 50% of the Canadian population lives in Ontario and British Columbia. It's just a tiny bit under. It might like 49.4 or something. That's the Canadian population. Ontario is the most populated province. Although 80,000 people did leave, this is something to consider for the audience. That yes, we received. There was a lot of immigration to Ontario. Like, Ontario was the bulk of all immigration for the last 3 years from out of Canada. But people who lived here left. 80,000 of them left last year. They thought, this is a very hard place to live. It's too expensive. So that is some consideration if we think that population growth is going to really slow. But we could have a new government in 40 days, and they could have a whole new set of ideas. Who knows? We're going to find out. But it is very interesting, and it is supportive of your thesis that we quit building single-family homes in about 2018, particularly in Ontario. It dropped down to only about 19% of all builds were low-rise starting in 2018. It's all been high-rise the whole time. And we're going to get to my favorite dog crate condo topic a little later in the show. But the reality is that is a real change. Like, it is such a profound change from like 150 years of housing. Yeah, that's an incredible change that happened in 2018.
And you can take it even further. Like the condos or apartments that are being built, they're also much smaller than what they were before. So again, not only have we switched from singles and semis to condos, but those condos continue to decline in size. So that low 200,000s number is far worse, far worse than what it kind of signals.
Yeah, the low to, and there's people who speculate that we might, by the time we finish 2025, we might be in like a 180,000 number. Like it could just be that bad.
Yeah.
Okay.
Yeah. A lot of developers are feeling pain. You can't really blame them for not being super aggressive in this climate.
Huge. So just run down what you think are your challenges today. Like, what keeps you up at night? What do you worry about in terms of your company?
Look, the reality is we've done a great job positioning ourselves. We've sold out of a lot of the non-core. We've shored up the balance sheet. We've paid off our revolving credit facility completely. We've got over $100 million of cash in the balance sheet. So we're well positioned on that front. As a public company, when the REITs are trading so poorly, that would normally be a big concern. You can't raise capital. You can't grow. You're kind of stuck. In our case, just being the largest, it's not as much of a concern. And quite frankly, it actually can be an opportunity because with this extra cash, I'm able to buy my own company at a big discount. So when it's a bit easier than looking to buy an apartment when I can go buy my own shares at a cheaper price, which reflects our own ones with no execution risk, no new due diligence. So I'd say that would be a typical concern. But in our case, we actually can use it as an advantage. The population growth stuff, of course, that's something that impacts the sector, and market rents coming down will, of course, impact the sector. But, even then, I would say from our end, our in-place rents are so much lower than market rents because of rent control. And the vast majority of our portfolio is under rent control. So even if market rents come down, you can still build a very solid case that revenue growth is going to be, decently positive, strongly positive, because again, when you're well below, you can still put renewal increases in and you still get uplifts on turnover. So I'd say right now there's no looming big fear for us right now. It's just we're adapting to this environment. Yes, we can't raise equity, but we can use our cash to buy back equity. We can get liquidity from selling assets that we were looking to sell to improve the building anyway, and we'll deal with the low population growth. I mean, the other thing to say, population growth is low now. There's an issue, and it sounds like we're going to talk about it with some of the deliveries of the condos. Yep. But when you unwind the NPR mission they're on to bring them from 7 to 5% of the population, they're saying about doing that in 2 years. This condo stuff, this glut is for 2 years. After that, I wonder how much supply you're going to be having delivered while all the while population growth resumes to normalcy. You might start seeing those conditions become ultra tight again, right?
Well, I think that talk about do a deep dive on the dog crate condo catastrophe in 416 in a minute, but I think it's also important to understand that landlords, big landlords, like when I was a kid,
rental housing providers,
but multifamily rental. When I was young, when I was in my 20s, we come into the 1980s. It was a big thing. There was lots of multifamily being built by professional landlords. And then it died. It died with the Paul Martin government. And there was no incentive to do it. And the wild thing, and this is sometimes people should realize, I don't think I'm smart. I've just been around. I'm old, so I've seen a lot. Okay. So what happened was, in the 1990s, the idea became, and certainly in the beginning, in the late 1980s, and then in the beginning, the middle of 1990 and onwards, the idea became that, hey, condos are the answer to a rental market. We don't need professional landlords. We don't need pension plans owning big buildings. We don't need REITs. We don't need any of that stuff. We need to make mom and pop an investor in a condo that they're going to rent out. And when the government saw that that was developing, the government said to themselves, federal government, provincial government said, hey, yeah, this would work. This will work. This will work. This will be a solution. Mom and pop can buy these condos and rent them out. Okay. But in the end, we're starting to discover that's a really shitty solution. That's a terrible solution. Okay. It took 15, 20 years to find out, but because of various trends and the way markets have changed, and probably the real disaster was 13 years of almost zero interest rates. And that made mom and pop think, yeah, this works great.
Yeah.
We're just going to assume that I can get a 2% interest rate forever. And,
and prices will appreciate.
Prices will appreciate dramatically, and and rents will go up substantially. Okay. Right. So that is really not true. Could you just take a minute and describe what succinct advantages a professional landlord owning thousands and thousands, tens of thousands of units has over mom and pop in terms of operational efficiencies?
Yeah, absolutely. And there's quite a few of them. We've got a whole head office team. So we've got really good intelligence on where market rents are, where they're going, what supplies are going to be like. We've got a national procurement team in there as well. Proper accounting. Like we've just got a lot of staff and a lot of really good insights on how the market is. We've also got a cheaper cost of debt financing in there as well. Diversification, so that if one market's doing poorly, there's no need to knee jerk or anything. Other markets will balance it out. When you own one or two units, if that unit's empty, you're at 100 or 50% vacancy, right?
It's true, yeah.
But for us, we can handle that, and we can do the right decision rather than fire sailing it to get it full. So there's a lot of good advantages in there, and the other one that I'd say is good for our investors is it's ultra liquid. Like, again, for the size of our company, you invest in a condo right now, go and try get liquidity. It's not easy, right?
Well, we can't even really even talk about it. It's so bad. Yeah,
exactly. Apart from getting higher yield and higher return from CAPREIT investment than you would from a condo, not having to do any property management or dealing with a bad tenant or a defaulting tenant or anything like that. You don't have to touch any of that, but you've got ultimate liquidity, right? You could sell your whole investment in a day or two, depends on the size of it or whatever. Sure. But
nothing. These individuals owning condos are ridiculously sticky. I mean, it's tremendous friction just to do anything with them.
Absolutely. So, and then the other thing too is, from our point of view, we have so much investment. We've got a really well staggered debt ladder. So if rates go up in any given point in time, it doesn't hurt us that much. But if it's your one mortgage and you're going from 1.5 to 5%, that hurts, right?
Yeah.
But for us, we tend to do 5 to 10 year money. It's well staggered. It never hits us very hard in any given year.
So let's break it down. You have, at any given moment, you have about a 25 to 30% rate advantage over the average consumer. So you have a significantly, by the way, it's intentional. It's government. The government, that's the one little thing the government gives landlords is that, hey, because of your stability and because of the nature of what you're doing, supplying housing for a large number of people who can't afford to buy a home, you get access to programs that give you better amortization and lower rates. That's fair, right?
Yeah, so we use CMHC insured mortgages and the spreads come in lower. I would say a big part of that too is like our leverage is 38% loan to value, right? So there's not much, and it's super diversified. So there's not much risk for them, right?
There's effectively zero risk because there's never been a claim.
That's how we view it.
Never been a claim, so that's fine. You have the advantage of the building is not being managed by a gang of fools who are the condo board, okay, who are at the mercy of unscrupulous property managers. Not every condo board, not every property manager, but you and I both know there have been horror stories of totally insane decisions made inside condos and complete graft and evil doings by the property management group. So you can end up with special assessments. You can end up with improper bad money being spent because, somebody's getting paid off somewhere. I'm not saying it's universal, but we have all encountered it in this town. That's happened. So your cost of maintenance is professional, intelligent, well-organized, and you don't get ripped off.
Yep.
So that's a significant, hey, what were we talking about? That if you buy a condo today and the developer tells you, the opening property monthly maintenance fee is going to be $450. You're effectively guaranteed in 5 years it's going to be $725. Okay, like you are guaranteed it's going to go up that much. You don't have those problems, do you?
No, we don't. No, again, a large diversified portfolio, and we've got an internal property management team as well, and everyone's very experienced, and we've got really good insights and professional management in the portfolio. I'd say not only just as an investor, for investors is it better than investing in condos, but I also say for the tenants, right? When you're in these condos, you might have a landlord residential housing provider that lives abroad or doesn't care or is non-responsive.
Yeah, good luck calling Hong Kong when the toilet doesn't work. Yeah,
yeah,
that's right.
You'll run into those types of issues. You also can run into issues where they might say, hey, my kid wants to move in there. You got to take your family and you're out, right? Like that doesn't happen in a purpose-built rental. So from an investment point of view, we think it makes a whole lot more sense than putting into condos. Not only that, but actually, like when you look at the cap rates that condos were trading at and still are, they're pretty tight.
Yeah.
You can go in the market right now and you can buy CAPREIT at a low 5 cap rate with a better cost of debt, internal property management, and ultra liquidity.
So you have those very specific tools and reasons why you're much more efficient than a mom and pop operator, lower cost, all those things. And they're real. They're not made up. They're real. You have people say, well, they make huge profits and because universally, this is one thing true about all humans. All humans hate their landlord. That's the truth. If you're a rent tenant, you hate your landlord. I know there'll be some replies on the post that, no, I've had the same landlord for 11 years and I love the guy. He's a nice old guy and he looks after us. Yeah, you're just one, okay? Majority of people have a lot of problems with their landlord. That's just the way we're built as humans. Mm-hmm. But you do have these significant operational advantages over a mom and pop owning 3 condos, okay? Mm-hmm. And all the other points you made about one's empty for 3 months, it's a balance sheet disaster and on and on. But like the other real strong suit that I encountered when we talked about it was that your basic rental, first of all, your product portfolio is much better in terms of the actual product people are renting than the hellacious dog crate condo. Yep. And you have a lower base rent overall. So tell us a little bit about that.
Yeah. So, I mean, the buildings that we own are typically traditional purpose-built rental buildings that were built for the long-term ownership. And so they were built with floor plans that make sense. Like in Toronto, we're around 900 square feet on average, right?
Wow. Double a dog crate condo.
Yeah, exactly. And so those are meant to be lived, and it's very viable to live there with a family. And you also, like we said, can't get evicted. But the other thing is predominantly the portfolio is rent controlled. And so what that means is that your rent, the in-place rents, average in-place rents for us around $1,600.
Wow, $1,600.
Right,
wow.
Quite affordable, right? Quite affordable. So
not just that, but contrast that with the condo rents, which if you look at every starting condo rent, they start with a 2.
Right.
Every single one of them. Okay. Even for the worst layout on the planet, they start with a 2. Sometimes 1,800, but you have a significant average rent improvement over anything that these people are offering.
Absolutely. So they're much more affordable. So you're going to get way less defaults. And what that also means is that even in this market where market rents may be ticking down a little bit, you're still going to see positive rent growth, because when you're below market, you can, even if market gyrates a little bit, you can still put renewals in and you'll still get increases on turnover. So maybe they'll be a little less than they would have been had market rents gone up, but they'll still be positive, right? And so that's a really good advantage for us. And being able to register positive rent growth even in this type of environment is good.
So I want to contrast, because I spent a lot of time on the podcast talking about the growing disaster of dog crate condos in 416. Mm-hmm. And I actually, there's some exposure in other cities as well. Okay. I mean, there is, I took a call 3 weeks ago from a Calgary condo operator who's literally worried about what's going to happen in 2.5 years when some of those places need to close. Some of those prices don't make sense. Mm-hmm. And they're also they know they're going to have some time selling off the reserve inventory that they kept. And there's basically worries everywhere in Canada right now. A guy called me and said, hey, do you know in Montreal, on some new buildings, they're offering 3 months free rent? Yeah. I mean, like Montreal was always a tight rental market, right? Mm-hmm. That was what we always understood, because they didn't have a ton of growth, so it was pretty static. But I guess they've built some units there as well. So but the interesting thing is, I've talked about rents falling. So rents today probably for the small stuff like under 600 square feet. And by the way, it can get much worse. I just looked at a 385 foot layout the other day that literally looked like some version of a bowling alley. Okay? It was just like absolutely nuts. And So we know the problems, but
Yep.
those rents are still, the theory of those rents was always that they'd be over $2,100. Okay, 20 over 2,000.
Yep.
And your rents, your average rent on a much bigger unit is substantially less.
Right.
So you have a built-in advantage.
Absolutely.
And you have some built-in resilience. Because look, I'm a hard-ass guy. I ask the questions about like, what the fuck's going to happen? I mean, we've got 45,000 more condos are going to need to be bought. They're coming on stream. They're going to be finished in the next 22 months.
Yep.
And that's a big impact. Essentially, all of them are meant for renters. Like, this is the crazy part. I've talked about it 1,000 times. It is like the craziness of just building one product for investors only.
Yeah.
Sure, somebody will argue that, oh, no, there's some luxury units. Yeah, it's like 6% of the market. Okay, like that's people who want to live in those. They planned on living in them. They bought it. And basically because they're people who have a certain age who can have a 5-year timeline before they move in, because it's their expected, they're thinking of retirement, of being empty nesters. But it's a tiny segment. It's only 6 or 7% of the whole marketplace. 94, 93% are only meant to be rented. Okay, so if it's a terrible layout, a rent that's falling, because, I don't know if the rent will ever get to $1,650 where you are, but that's an economic disaster of untold proportions for these new condos to think that that to compete effectively for when you calculated your purchase of this condo, you thought would be, well, I'm going to get at least 2,400. Now it's down to say 2,150, and it's headed below 2,000. It's a phenomenal financial disaster. But you have a bigger unit in a better building that's at $1,650
with better management and no risk of getting evicted. So it is truly somewhere where you can rent and raise your family and not be worried about getting kicked out or having too small of a layout. So we think that adds to the defensiveness. Also, a lot of the uncertainty that I think is really unduly hitting our stock price, that might translate into people staying renting longer and not buying homes. Like, in the face of uncertainty.
That's a fact.
Right.
I will do a shout out to the analysts who none of them are listening, but if they were, I would do that shout out. If you think there's going to be some sudden rush for people graduating from rent to purchase, we see no sign of it.
Yeah, you've got unemployment high and this tariff uncertainty, all these uncertainties that are playing in. Like I suspect that'll push more people or keep more people into the rental market. And, that's a big part of why we view multifamily as a counter-cyclical business, that especially when you come to what the vast majority of our portfolio is again, affordable family-sized units, right?
Which are because of this incredible boom in dog crate-sized units, it makes your properties more
right. The other point I'll make is, you were talking about some tough scenarios with rents pushing down further.
Sure.
I think that will only exacerbate, and whether that's true or not, we can debate it. I think there's a lot of trapped roommating that's going on and people living in situations that they never planned on living in the long term. And if rents do tick down, that might free them up and create some natural demand to offset the population. I don't know, but we do think there's some the same things that when population growth was moving really high up throttled the demand. I think some of those will unwind on the way down, but what I'll also say is I think it exacerbates the housing crisis, because if you see a bit of softness in rents, construction costs are very high, and developers are a little bit more in defense mode than offense mode, what's going to happen when the non-permanent resident noise finishes in 2 years from now and you resume back? We're not going to go back to the north of 1 million people a year, but if you get to the normal 400,000, which is still a pretty elevated growth rate, 400,000 people coming and no development coming online, that's a good recipe for rising rents, right?
Well, even the low end of the spectrum is about 350. So we want to add 300. The government's committed to adding 350,000 permanent residents per year. That's down from the 550 numbers they were using. And of course they've kind of pushed all the student visas and the temporary visas aside, but there's catch up to do. But like I'll fight you a bit. I'll fight you a bit on the roommating, because I believe that unemployment will get worse, and there's no fix to unemployment. There's no fixed unemployment. Particularly, it's going to get worse in the GTA for a couple of different reasons. First of all, we're going to have less construction every month. There's a tower completes, 2 towers complete, and that crew has got nothing to do anymore. There's no new towers. We both know that. So I think there's going to be softness in construction. I think that in the face of, if the tariff threat continues for any length of time, even if it's 6 or 8 months, that there's going to be more unemployment in all sectors, because a lot of people don't realize it, but it's not just automotive, it's not just steel, it's not just aluminum. If a bank thinks their business is going to be down, they just lay people off quietly. Quietly, they lay people off, okay? That's the reality of every business. We've got 10,000 people, sorry, RioCan, but we got 10,000 people going to be out of work at the Bay. And, it all adds up. My belief is that if people cannot afford rent, that I don't think roommating is going to actually decline. I think there's a possibility of increase in roommating. But to that point, you still have the better product. You see, to my mind, as a grown-ass man, old guy, I think in many cases product rules. Because the product that's coming on stream, the next 40,000 dog crate condos, are literally worse than ever. Like, they are worse layouts, smaller units, crappier buildings, you name it. Like, and hey, I'm talking to a guy just spoke to somebody just last week who is committed to a 445 square foot unit for $960,000. Recon.
Wow.
Like, major mistake. Yes.
Wow.
Major error. He admits it. Great location, famous address, the whole 9 yards. But wow, that doesn't work. Okay. So will all of these sort of real estate disasters contribute to more depression in the economy? Not a depression, but depress the economy. So I think there's a potential for more roommating, not less, for more people going back home to live because they don't have any choice. Unemployment is the worst thing for an economist. Economists will tell you, yeah, it's the worst. Nothing's as bad as this. Runaway inflation, it's about, Weimar Republic inflation and high levels of unemployment. They're the 2 biggest problems we have as an economy. So, but I still like your corporate thesis, because at the end of the day, I feel so strongly the pushback on this garbage product because sometimes I even ask myself, what the hell happened in the city planning offices? They would say, we love density, right? So we want to see if we can just keep shrinking the units till they're just one step up from a tube apartment in Seoul or Hong Kong. Like a tube apartment where you just open a hatch and that's where you sleep, right? Okay. I mean, people think I'm crazy, but I can show you. They exist. So that was a major mistake, in my opinion, a major mistake. So I so support the idea that your average is 900 square feet. I mean, fantastic. Okay. Like that's a livable unit.
That's
absolutely
very livable.
100%. Okay. And God knows if we just had a city that was not stupid about density, that we would have more of those in the condo space.
And I do think that's the difference between purpose-built development and condo development, because as a developer, your goal is not to own the building for the long term. It's to do a quick sale at the maximum price per foot, effectively, right? I mean, I'm probably oversimplifying that, but when you own a purpose-built rental, the idea is like, I have to go through the lease up on that thing, and I need to be dealing with the turnover every year, and I need to make sure that that this becomes a functional, livable place for families and people.
Well, you think decades out.
Right.
You have no choice. That's exactly you have no option. You think decades out.
When we buy a building, it's with the intention is essentially to own it forever. And so we're thinking about problems that we're going to get 30 days in, 1 year, 2 year, 5 years in, right? And
you're thinking about 10-year problems. You're thinking about decade problems.
Exactly, right?
Where there is not, the only objective of a condo developer is to close the condo corp, pay off my bank covenants, right, take the profit and leave. Right. Okay. There's no other thought process involved. Okay. Right. Zero. I know they'll fight me on that. They'll all fight me on that. No. We worry about the quality of the building. We worry about this. We worry about that. Well, okay. I'll even accept that some of you have decent quality in your building, but your layouts are awful. Like, just awful. Mm-hmm. Like, I mean, we talked earlier before the show about, you open your front door and it's your bedroom. Or the bowling alley, right? The bowling alley, what's going on with that place, right? I mean, like, and how about virtually no natural light?
Yeah, and
Seen
the
that
thing
too.
is maybe there's a place for a few of those units, but when there's so many of them, and you question about how how many families or people in the city can live in that, and like how good can absorption be? Again, not talking our book too much, but contrasting that to ours, it's kind of a different
No,
task.
look, talk your book. Talk about absorption. Talk about the fact that, I mean, you reach a point where when the person moves in, wherever a person moves into the bowling alley, open the door to your bedroom, 4 elevators, one of them never works, and you're 6 or 7 minutes just to get in the elevator, and you really don't, once you've settled into your place, you really wish you weren't there. That's an absorption issue, right? I mean, that is like, I just want to get the hell out of here as soon as I can.
And that can lead to very quick turnover. And then, so you're always constantly leasing if you can lease, right? So that for us, not our model, not what we think is kind of the best the best type of product to invest in for us.
So there has been growth in purpose-built rentals in the last 5 years. That's fair, right?
Yeah. So what happened before, like in Toronto, was just the values, the condo values that people were willing to pay on a per foot basis were so much higher than apartments. I mean, they're very similar buildings, and so if you're going to spend money building an apartment or a condo, one's worth 50% more. People were pivoting towards condos, but I think naturally that demand has really dried up, and there's also been some good programs coming from CMHC as well. So we're seeing a little bit more of a pivot towards purpose-built rental. But the truth of it is in most of the markets we're looking at, the math is still really tough. The cost of building. When we look at pro formas to build and we look at the cost per foot, and I say, well, what would I pay for that building if it was already built? Oftentimes it's lower. In fact, we did around $700 million of acquisitions across the country, all newish or recent build properties, and the vast majority of them were at substantial discounts to construction costs. So even then, I query how much can you really see of that going on when, again, the end value in a lot of cases is less than the costs.
Is that a function of exacerbated? Well, let's see where the functionality could be. So is the high cost a function? Sure, we all talk about increases in construction costs and trades, but I really firmly believe that that's over-exaggerated. So let's think about land cost has risen until recently.
Yeah.
Until a year and a half ago, land costs went up exponentially everywhere.
Right.
And it's also fair to say, here's one thing I don't know, so I'm going to ask you. Are you as impacted by development fees as a condo owner is?
Yeah, so the development fee, effectively the wide range between CBCs, parkland taxes, DCs, all of that, we're in the 20 to 30% of total construction costs. If you take that off, maybe the math
So you're
starts
still
working.
20% of construction costs.
Of your overall development
costs are still forms of taxes, development fees, levies, something government is charging.
Depends
you.
on what municipality. Of course, it changes quite a bit. We see Vaughan do something very nice.
Right.
We've seen Mississauga do something very impactful.
But you saw nothing but growth in those government costs. So you're not exempt from those costs. Because it's a rental, you're not exempt.
No. I mean, there's certain things. There's the waiver on HST in some markets for sure. Sure. But no, it's still a very heavy part of it. And so when we look at it, and we're not developers, so you know what I mean. We don't develop, so not super.
But it's part of your cost formula.
But it is, when we're we do have a lot of excess lands. We do look at it to see if it's profitable, but it always comes back that I'd rather just buy the building down the street 20% less.
Because the building down the street, even if it's in some cases 5 or 6 years old, which is still a long life ahead of it. It had a lower development cost structure when it got built, and a lower land cost structure when it was first built. Okay?
So you can when you go to buildings that are like 5 years old, I can still do a price that makes sense, gives us a good return, and adds to the portfolio's cash flow, and still made sense for that developer. Like he didn't lose necessarily money on it because to your point, he bought the land 10 plus years ago, and his costs are much, much lower. Like since COVID, construction costs of I've seen different numbers, but I've seen up to 60% across the CMAs. I've seen higher in Toronto. They went up so much. So a 5-year-old building, his cost base is going to be a lot less than necessarily the guy coming online right now. But of course, the heavy fees, the really long 2-3 year approval timelines, like none of that stuff helps, right?
None of it. So in your assessment of what to buy, the newest stuff is in the worst position. It's had the highest land costs. It's had the enormously long planning and approval times. which somebody had to finance, right? That's a cost.
Yeah, and the interest rates were higher recently too.
Interest rates were higher recently, and then finally, even like just abysmally bad, is that the land cost was levered multiple times in the most recent iteration, and it all just contributes. It all just comes.
Yeah.
And even if construction costs are up, they're not the majority of the cost increase. They're nowhere near the majority of the cost increase. So you have to. So this, to me, this is a very, very interesting piece of information, and it should be for the audience, that as recently as 5 or 6 years ago, the cost structures were so different.
Yep.
It actually makes sense to you.
Yeah.
To be able to buy a property, look forward for 30 or 40 years, and say we can comfortably make money here.
Yeah, absolutely. And like when we're buying a building, I'm not really fussed about what the developer's costs were. I mean, we're just buying the cash flow.
You shouldn't care. Yeah.
Yeah, we're present valuing the cash flow.
Yeah.
So what really ends up happening in a lot of cases when it's a brand new building and someone brings it to us, we'll say, well, this is what we view the present value of the cash flows to be. This is the offer we'd be at. And they say, okay, well, that's 20% below my cost. I need to recover my cost and then make a profit or something. And then we say, well, that's the definition of a bid-ask spread. Yep. And they're not wrong for wanting that. I mean,
no, they're not wrong.
You put a ton of effort in, took a lot of risk, and that is it. But we're also not wrong for wanting to earn a reasonable return on it, and that's where you get a bid-ask spread and some liquidity. So there are cases where brand new construction can work. Lower cost structure in a higher rent area. There's some cases where that works. Or if you have a distressed seller that says, regardless of what my costs are, I just have to hit the bid. But then when you go back 5 years, both sides can, be happier with it, right? Like if the developer is making money, and of course, we want to earn a good return. We're not looking for developers to not make money. In fact, we want them to be around.
I think you should be fine with it. I mean, I think you should be okay with them not making money, but that's okay. I mean, because let's face it, in some cases, mistakes were made. Okay,
absolutely. But in the end of the day, we want more developers. Like I get it. There's a pause on the housing crisis because of the population growth and the glut of condo stuff coming online. But that will unwind, and it'll unwind. It's not good for anyone if all these developers feel too much pain and don't want to come and add supply when we need it again in the next kind of year and a half or two.
It's more like 4 years, but that's fine. Split hairs on that. But I mean, at the end of the day, what we have to realize as a country, particularly in Ontario and particularly in GTA, is that there's been pricing errors that resemble a tulip bubble. That's just the truth, and it's all going to come home to roost. And one of the great things about what you've told us today is that there's a bunch of stuff to rent that's a better product at a better price. I mean, that's just the truth.
Yeah.
Now, you are fairly highly rented out. You're like in the 95 range. I mean...
No, we're higher than that.
Higher than that.
Yeah,
So
97 to 98% range,
So people can't even access your good deal, realistically.
Yeah.
It's very tough for them to access.
And the turnover's been pretty low in the portfolio because people don't want to leave if they've locked in kind of lower rates.
So, I mean, the thing... And again, by the way, like I am supportive of your thesis that it's defensive. I mean, people still need a place to live. We're not going to empty the province out. Okay, lower population growth is not a pure negative on your scenario. No. Okay, if you have the better product, the lower cost, and you have more people interested in staying longer. Yeah, hell yeah, you've got a good product. Okay,
absolutely,
you got a good deal. We can talk about you're sort of impacted by the universe of difficulty for the whole REIT space because it's not always just a pure multifamily play.
Yeah.
But to finish off on this upcoming and growing, and we're seeing like more cracks daily. I'm looking at a project where I'm getting feedback from lawyers, feedback from realtors, feedback from all kinds of people. A Yorkville project, which needs to close to form the Condo Corp. And the prices are off the hook because it's Yorkville. And it's the people have paid, like I said, $900 plus for 455 square feet.
Right.
$2,000 a foot. Yeah. And they're realistically, the right price today is about $1,100 for a great address, for a superb address. And it looks like 40% of that building can't close. Okay, like 40% of the people are walking away, take the lawsuit, whatever it takes.
Right.
And we talked earlier at an earlier point in the day about the fact that in theory, condo corps can close even with big 50, 60%. 50, maybe I know for a fact 50 is possible. 50 is everybody's told me 50 is legal. There's some debate about going down to 60 or 70, but Condo corps can close at 50, but at a certain point, the developer runs into their banking covenants at a certain point, and they need to come up with their own money to satisfy the bank, or they need to be solvent enough and have a good enough balance sheet for the bank to say, we can go along with this at higher rates. And we're gonna, you're finished now, so that contract's gone. You met that covenant, so you should close and pay us off. So we need to renegotiate something at a much higher rate because there's more risk involved. And there's going to come a point where eventually, not today, but eventually some of these developers will find that they just can't get the support from their lenders and they don't have a big enough balance sheet.
Yep.
And at some point, I don't know if you agree, and I don't pretend it's your expertise, that some of these places could go into receivership.
Yeah, it's quite possible, right?
But that might not be a buying opportunity for you, right?
Yeah, not entirely sure that will be. I mean, it's something we're monitoring closely. I mean, as the chief investment officer, I mean, that's my job, to be sourcing acquisitions. So I've talked to lawyers, I've talked to a lot of developers about it. There's a couple of issues. One is, what's the value of those? I mean, some of these sold for $2,000, $1,500 a foot. That doesn't make sense for us at all. We're an income buyer, right? And so, when you see rents in Toronto in kind of the $4 a foot range, I mean, that doesn't translate into values that are north of $1,000 a foot, right?
Not at all.
And so, would we be there at the values that they want? I'm not sure. We're going to be at values that kind of make sense on a cash flow basis. The other part is, if they are units that aren't desirable, like really, really small ones. I mean, again, is that something we necessarily want to step in?
Because you're thinking decades in the future.
We're thinking decades in the future. And again, when you have all these units that families can't live in, they're going to be high turnover units, and that's going to come with a cost to it and more vacancy, more staffing.
Economics don't make sense to you.
And right. And so the price, I mean, there's a price for anything, but the price might not be as great as they necessarily want. The other part of it too is buying a building where you don't own the whole thing, and you're dealing with a condo corp.
Because some of the people closed.
Yeah. So then that also would require a discount. And so there's a lot of factors there that make me think it's less likely. Of course, we're not writing it off, and we're going to
You're not ignoring it.
No. Yeah. And then you say, in terms of the REITs, I'd say right now the REITs don't have access to capital. We're all trading at big discounts to our underlying values. Nobody can raise capital. In fact, I'd say most of the REITs now are probably net sellers or net neutral. I mean, there's exceptions. We're very fortunate because, again, like I said, we sold a lot of the ancillary stuff to the business, and we shored up a lot of capital. So we are able to do it. We're able to do it quickly. We've got a huge team, so we can underwrite acquisitions in a very reliable way very quickly. I'm just not convinced that this is going to be such a big opportunity, again, because potentially you'll have tenants living throughout the building. There are layouts we may not want to take on. Potentially, again, there's going to be somewhere they are.
Could be some finishes and workmanship you're not there.
Right. And then, on top of that, the values we pay, we're an income-based buyer. We're a REIT. We have, we need to generate positive, appropriate returns for our investors. And so it has to be in that context, right?
Absolutely. So before we close, I want to touch on what I think is a wonderful thing that you mentioned to me, is that occasionally my name comes up amongst developers for, amongst other things, for coining the phrase Dog Creek condos. Because it started with shoebox condos, and I thought I needed something more pejorative, so I developed that. But sometimes when my thoughts come up, my views come up with developers, their basic feedback is, well, the fat fuck's wrong. Is that fair to say? That's maybe they don't say fat fuck, but a few of them do.
I don't think anyone does. I want to believe nobody says that, Ron. And I think
they do.
You're a great guy, but no. I mean, look, you have a reputation for having a very strong view. I think some people say Ron just tells it how it is. Some people say maybe he's being a little bit dramatic or overly negative. But you're sharing your view. I'm sharing my view. We're all sharing our view, and that's totally fine.
I'm fortunate. I like your view.
Well, thank you.
I like your view.
We like it too.
I like your view of delivering rational floor plans, rational space allocations, rational rents to the public. I get it. Nobody loves landlords, but at the end of the day, based on the simple metrics you've described, you're a better offering to humans who need to rent.
Absolutely.
Than the rest of these people.
And on top of that, better cost of financing, and today you can buy it at a 25% discount to the net asset value. So at net asset value, it makes sense. And by the way, we did over $3 billion of transactions last year. We sold all the selling we did was at or above our appraisal value. We feel good about it. Is every building perfectly valued? I can't guarantee that.
They never are.
But the fact that we did so much value, so much volume in a fairly illiquid market above those book values gives us pretty good confidence. So to be able to buy that 25% below, we think is a great investment.
Julian, thank you. You're a great guest, and boy, I can never stop emphasizing that organizations that are supplying an average of 900 square foot, in many cases, in a lot of cases, 900 square foot dwellings to people who can live a normal life is a benefit, and thank you for that.
Thanks, Ron. Appreciate having me on.
My pleasure. Okay, we're out.
If you like the pod, well, don't just sit there. Go to YouTube, Apple, Spotify, and all the other ones and like the pod. And don't forget to subscribe so we can keep being angry at mortgages and swearing about mortgages. Angry Mortgage could use your support.